How you doing, friends? This is Ernie with 0 Days to Expiration. That's 0-DTE.com. And this is going to be a special episode that's going to give you an idea of what it's like to be a trial member or a first-time member or a new member of the service. So I'm making this a public video so that everybody can see it, as well as our new members. So there's not much here that I am, I'm not giving away the farm here. But it is still important, and it will tell you, just exactly what we do here at 0-DTE. So first of all, it's a 4-week trial. Each week is individually priced, so it's $19.99 a week for 4 weeks. You can go all 4 weeks. You can go 1 week. You can go 3 weeks. You can do whatever you want. After that, if you decide to, or any time after that, you decide to join, then you can join and become a full-fledged member. Now, of course, as a trial member, you have all the same membership privileges as a full member. So you have everything. All right. So when you join, you're going to get an email that says, "Hey, join the Discord," and so you'll join my Discord. You'll tell me that you're there, and then I will provide you access to the free Discord. This is what you're going to see. Well, that's not what you're going to see. That's my website. You're going to see this. You're actually going to come in right about here after you've signed up, and there's a bunch of other people that have come in and said, "Hey, here I am, Ernie." And when I give you access, down here, the member rooms are where you're going to spend most of your time. As you can see, there are hundreds and hundreds and hundreds and hundreds and hundreds of traders here that are very, very friendly, very experienced, and more than willing to lend a hand. And there's also this is the room where we talk about the trade of the day and what's going on and the strategy. And this is the room where we hang out and talk about other trading related stuff. Okay? There are also all of these other channels where I do my daily analysis of the markets, where there are alerts, lots of alerts with a narrative around them. And then, of course, I put in my personal fills when I take a trade. There are some, excuse me. There are also some public channels where you can talk. If you don't, if you want to just join the Discord, you can also do that. The link is below. And talk to other people. All right, so let's get down to what we do. Every morning, I'm going to provide an analysis of the markets. And in that analysis, I'm going to provide what I think is my daily bias, the bias of that day. So here's today. I'll provide the volume profile analysis as well as some scenarios. I usually call them Scenario 1 and Scenario 2. I don't know. Let's take a look at what happened today so we can sort of compare that. All right. So it looks like both of the scenarios actually worked out. Scenario 1 was to come up to the top of this volume node that is indicated by this shaded area. And scenario 2 was that we would come down to this LVN, or low value node, or low volume node, right here. And so far it looks like we've done both. I didn't imagine much more than that, but there we are. So that's a typical analysis. Yesterday, these darker lines was yesterday's analysis, that we would come down and then come up. Unfortunately, we didn't come up as far as I thought, so we came a little bit short, as you saw in the video last night. All right, so we get that every day. We get that analysis, and somewhere during that day, in the talk channel, I may provide, if I think things are, going our way, I may provide some ideas that I'll ask people to stage trades. And usually those staged trades actually turn into real trades. Let's go back to the big head here. So I'll provide these ideas, and people will either have their own ideas, which is really what we're geared towards. We're hoping, or I'm hoping, that after you've spent enough time here and you've learned the entire system, that you will develop your own methodology that it can be built off of mine. It can be parroting mine if you want. I would prefer that you make it your own. And people will come up with their own trades or follow my trades and then start doing their own analysis and figure out where to model the scenarios and so forth. And then I'll usually take a trade that's built off of one of those ideas, those staged trades. And then we will follow that through as a group throughout the day and provide analysis and try to manage our profits. Now, we don't manage risk, we manage profits because we do the inversion of risk. Very, very different. Now, this is one of the things that you're going to have to get your mind around. When you come here, we do not do high probability trades, high probability iron condors like most people do in 0-DTE. We do something very, very different. We do the inverse of that. We do not take huge risks to make tiny little profits. We take tiny risk to potentially make huge profits. Very, very different. And so once you get your mind around that and understand that this strategy is designed to grow an account over the long term. It is not designed to try to create like some minuscule little bit of income with huge risk behind you day to day. That's not what we do. So that means that you can trade super small. And that also means in this particular environment, in this coming recession, if we're not already in a recession right now, in a huge down market, when everything's going wrong and volatility is all over the place, this is the ideal strategy. When the market's going up, this is also the ideal strategy because you are, well, first of all, implied volatility will be at your back. But in a recessionary time, you're never risking too much. You're always risking a very tiny amount, and you're taking advantage of opportunities. Now, within a recessionary or a bear market, we always have increases in volatility. That increase in volatility will pump up the premium that are in our strategies. That's a good time to actually, after you've reached some sort of maximum for the day, that's a great time to enter the trade because now you've got inflated premium. You have, what will probably be your best risk to reward. And then what you're hoping for at the end of the day, and hope is not the best word, but we try to plan it in such a way that you are waiting until that end of the day when implied volatility starts backing off a little bit. When that happens, and that in combination with time, because we're doing 0-DTE, your premium will start exploding or start growing very quickly. And if you're in the right spot, you're going to profit. And you don't have to be inside the profit tent of our strategies to profit. You just have to be near it. Of course, if you're inside the profit tent, then we have these huge outsized returns. Most of our returns are on average about 100, 150 to 200% return on the risk that we take. And that happens probably about, I would say, 55 to 65% of the time. And then about 10 or 15% of the time, we get those outsized returns where you can have a return that's 400, 800, even 1,500% of the risk that you take on. So if you look at that and you start imagining, well, what is this all about? You're in this to take small losses so that you can put yourself into a position for some spectrum of gains, some of which are going to be huge gains. And what this results in is very low drawdowns and sometimes, sideways movement, but very, very small drawdowns. And then every once in a while you make these advances and then step up and step up. So this is like the perfect strategy for somebody who is risk adverse and just wants to grow their account, or even somebody that has a very small account and wants to grow it big. Now, generally, the amount of risk that you take is kind of proportional to the size of your account and probably different than what you're thinking. When you have a very small account, as a percentage of that size of that account, you're probably taking on more risk. And that's really a natural consequence of the size of the positions, because you can only get so small when you're putting on one of these positions. And so you may only put on one position. If you have a $2,000 or $3,000 account, it's going to appear, large in relation to that. So in the beginning, when you have a small account, your equity, your return equity, may be a little bit more volatile because of the size of your account. As your account grows, you don't grow the size of your positions until you get to a certain point, and that point is fairly well up there. But as your account's growing, that volatility of your return starts getting smaller and smaller, and gradually starts stepping up.
New visitor.
And so
New visitor.
This makes it very easy to take a small account and actually grow it very rapidly over the course of, say, 6 months, 8 months, a year. As a matter of fact, when I first started this service last year, I started in April of 2021, I started with a $3,000 account, and I brought it up to $9,000. Now, I'll have to admit that at that point, in January of this year, I made a very stupid mistake. And we were trying different types of strategies, of which we don't do anymore. We were trying a strategy that had some outlier risk. And the idea was, well, it's such an outlier. It's 3.5 standard deviations away. It would never happen. And what happened? It happened twice in a row. Huge losses. Now, we revised our strategy. Now we no longer do that. Now everything is just a uniform risk, very, very small, and so we never get into those situations. Now, why did that happen? Or how did we come to the conclusion that we had to eliminate that from our basket of strategies? The reason is that we do something here called an Agile continuous improvement process. Now, what that means is that, well, we're taking 3 to 5 trades a week, and each trade we look at as a separate little project, and we review that at the end of the day. And at the end of each week, we review those trades as a whole and how we're approaching the strategy. What are the market conditions? And is there anything that we learned? What did we do right? What did we do wrong? Is there anything that we can change in the strategy and then bring that forward to the coming week? Now, we've been doing this right from the very beginning. So the strategy has actually evolved this entire time since the beginning of April of 2021 to this present day. And it continues to evolve. And all of that happens in a retrospective meeting that we have every week. All the members get together, and we review this, and we decide whether or not there should be some material changes, additions, whatever, to improve our process. So that is how things go here at 0-DTE.com. Now I'm going to talk a little bit about the actual strategies or the process that we do every day. The process is pretty simple. It's a 4-step process. And of course, we have this underlying tenet that we're taking asymmetric trades with tiny risk and very large potential profit. And that is because there is a positive expectancy with that type of trade. In general, it is a lower probability trade, but it has a positive expectancy. Unlike what most people are doing, say, trading the tasty trade way, where the fallacy is that you can dial in your pop and rock, your probability of profit and your return on capital. And if you put on enough trades with a law of large numbers, that you will eventually head towards that nirvana trade world that you think that you're creating for yourself. This couldn't be more wrong. It is so wrong. In fact, it was really designed by a fellow named Tom Sosnoff and his cohorts to feed into a brokerage that he was creating. It's designed to create a lot of transactions, and that benefits the brokerage. Sure, they give away a lot of fantastic information about trading, except for their strategy. Their strategy is designed for them to make money, not for you. And that is taking these sort of high probability, lots of trades and all different strategies. It doesn't matter what, it's just wrong. All professional traders that I know make money by taking small risks. And this doesn't even, it's not even limited to just traders. This has to do with virtually everybody in every profession, every entrepreneur, every business person, everybody that is used to taking risks. They fail a lot, but they fail small. And they're always trying to put themselves into a position where they can win big. That way they can stay in the game and live to fight another day and maximize their resources. That's what we do here. We expect to fail a fair amount of time, but fail small. So our drawdowns are very small. We're always in the game. We have skin in the game. And when we're there and things work out, we make big advances. That's how you grow an account. That's how you become successful. That's how you become, a real estate tycoon or a business mogul or an author or anyone that takes chances. Right? You're taking small chances, but you are persistent at them because someday they're going to pay off. Our case, someday is like, on average about 2, maybe 3 times a week. So it's not like, we're waiting for, the everything to rain down on us someday in the future. But it's all scaled. All right, so let's talk a little bit about the. Let's see, we got to go to the iPad here, and it's supposed to recognize me, I think. Well, we don't want you to see the password. I don't know why it's not recognizing my face. Let's see what we got here. Alrighty. So I'm going to do a little primer on how we actually put a trade together. All right. So generally, we're trading butterflies. Out of the money butterflies. What we're trying to do is, because it's 0-DTE and because we're expecting premium to decay throughout the day and accelerate as we get closer to the end of the day, we want a strategy that will give us the widest possible range of profit potential and then also be able to kind of time things so that we're moving into that profit potential as best we can. Sometimes we don't get all the way into a butterfly. Sometimes we just end up on the edges. Sometimes we get close and then move away. And those are the odds that you take. Those are the chances that you take. But the cool thing about this is that as that premium decays and that profit line grows, as it grows, I'll show you this in a second. If you're anywhere close, you can gain multiples, usually triple-digit returns on your risk. So here's an example. So I'll draw a profit graph first. Just a simple profit graph that you see in all your strategies. And let's say that you're sitting right here. This is at the money. And you've done your analysis, your volume profile, and you think that price is going to go up maybe to some level that is indicated by the volume profile analysis and your geo-macroeconomic analysis, of course. So then what we'll do is we'll create those scenarios, and from those scenarios and the structural analysis, we will model a trade. And so then we will put a butterfly on out of the money that will look something like this. So let's say that we decide that, well, right about here is a good place to put our center strike. So we will model a trade that will look something like this. Now, notice what you see about this. First of all, very small risk to very large potential profit. Typically, we're looking at something like, let's see, something like a 1 to 10 risk to reward. When we put a trade on like this, our profit curve will look like this initially. Nice and flat. But our range of profit will be something like this. Very, very wide. And of course, we're expecting to move up. We're expecting to move this way into that profit tent, while during the day, that profit curve is growing. And as it grows, that might be one growth spurt. And then maybe a little later on, it will look, something like this, until it fills the profit tent at expiration, because that's what it's doing. It's going to fill that up. But here's the cool part. While you're on this journey this way, and you're right here during the day, you have actually gained profit right there. And that profit is usually pretty significant compared to your risk. Usually somewhere between 75 and 150% of your risk. That's happening a good portion of the time if you're good at least at getting the direction halfway right. And of course, we don't take our trades until usually mid to late morning, until the market has more or less established its direction. And so our analysis of getting things fairly right are really, really high. Our directional analysis is probably 90%. Our vector analysis, or the strength of that direction, is probably closer to about 75%. But we don't have to be perfect. About 10 or 15% of the time, it'll take us right into the center strike of that butterfly, where we can potentially get what we call a pinned trade and make as much as 1,000% in the case of a 1 to 10 risk to reward. Sometimes we put on trades that are better than that, 1 to 15. We could potentially make, a 15 times our risk reward, or 1,500%. But that happens, like I said, about 10, 15% of the time, or about, once a week, once every week and a half, or something like that. The rest of the time, we're making something on that spectrum. Usually most of those are in the 75 to 200% return range, with a small percentage of them actually being full losses. But because the risk is so small, you do not feel those losses. They're relatively small. Now, you may come up with a strategy where you might want to put on a few of these different flies during the day to kind of, increase your risk, your probability of, or decrease your risk and increase your probability of profit. We found that that's really not the best way to trade. We have this one trade that we call the Batman trade, where you bookend your at the money, and you bookend it with two butterflies, one on each side. And it might look something like this. Here, we'll go to a new. We're going to do the Batman trade. So we might be right here, and we're not really sure about direction. We don't know if it's going this way or that way. So we'll put on two trades. We'll put one here and one here. Now, the problem with that is that their combined risk ends up being additive. And you can only profit on one of these at a time. So now your risk to reward has been diminished dramatically. You might get to maybe 1 to 4. So if you're lucky, you might get one of these. And if you end up right in the middle here at expiration, your profit line could look something like this. So while the Batman trade might seem like it's a guaranteed profit, it really isn't. See, again, the whole premise behind what we do here is capital efficiency, risk to reward. Take tiny, tiny risks and accept those risks in the event that you're wrong. But if you're right, you're going to get rewarded. And that's what this is all about. And that is the mind shift that has to happen with traders that are coming to this service, is to forget this high probability stuff. Go for the low probability trade, which is kind of a misnomer. It's not really low probability. We actually profit on a fairly regular basis. The difference is that we're never sweating the risk, ever. Never sweating the risk as long as you stick to that tenet that you're only going to take small risks. And you're going to thank yourself in your account. And especially in times like now with a recession, it's going to make it much easier for you to weather that recession, and knowing that your account really isn't going down, but it is going up, right? All because you have patience. Now, of course, another big part of this service, we're not just an alert service. As a matter of fact, I would say that we're not an alert service at all. This service is really a coaching and a mentoring service that is teaching you how to trade this system. And a system is more than just alerts. It is the entire process. Remember, I had mentioned the Agile continuous improvement process. There are methods and strategies within this process. Of course, we have at least a few different strategies. We have our primary strategy, and then we have profit-taking strategies. We also have strategies for avoiding different pitfalls of trading different types of assets, like the pattern day trader rule. Then we also have methodologies. There are very many methodologies. Our primary one, obviously, is the volume profile analysis and volume flow analysis. We look at options chain, options interest, and volume in the options chain, and market structure. All of these things come into play, and of course, figuring out the geo-macroeconomic condition is a huge part of our strategy and our methodology, and understanding what energies are coming into the market so that we can make accurate predictions about where price is going to go, what we call the vector, the direction and magnitude of that direction. Then, of course, there's the mental side. And the mental side are things that we do to condition ourselves. We go through process every day, the same process every day. We are process obsessed. That is really what this service is about. Teaching you the general process, how to handle yourself through that process, and then how to become an expert at each of the methodologies and the strategies that are individual to that some of them are directly related to putting the trade on, others are more related to keeping your mind straight. So that is what this service is about. That is what 0-DTE.com is all about. We are not just an alert service. We are, without a doubt, probably the best supported, most accessible, most transparent service on the internet. And you're going to get coaching and mentoring from a 40-year veteran that has coached and mentored C-level execs from Fortune 5s down to mom and pops and dozens of traders. Well, actually, if you look at my service, hundreds and hundreds and hundreds of traders. That is what 0-DTE is all about. That is what you can expect as a trial member and as a full-fledged member when you join. All right, hopefully that this was... Okay, we got a question here. How scalable is this strategy? That's a very good question. Now, there's the great part about this. That this strategy, I hate to use these kind of platitudes, but I mean, it is really infinitely scalable. Now, I guess that really depends on what you consider the high end, right? On the low end, you can start with just a few $1,000s, and you can actually grow fairly quickly a small account into a tradable account where you can start adding multiple positions in a relatively short time. It might take you 9 months to a year and a half, but it will happen over time. You'll have this sort of kind of growth curve where all of a sudden, hockey stick, go like this, and then all of a sudden you start taking off. I could even, maybe demonstrate that. Let's go back to the gallery and add. This is typical of a growth curve here in 0-DTE, where you start like this, and then it's maybe a little bit of volatility, and then all of a sudden it starts doing this. That is very, very typical of growth in this strategy. But in terms of scalability, that really comes down to what your risk capacity is and tolerance and the size of your account. It's irrespective of the strategy. When you get to larger accounts, your risk size relative to the size of your account starts getting smaller. So when it's a small account, you might be, risking 5% to 10% of your strategy. Then you get up to a little bit bigger, maybe to a $10,000 or a $15,000 account. Then that shrinks down to maybe 3 to 5%. You get to a 25,000, it goes a little further, maybe down to 1.5 to 2%. You go to 100,000, now you're at 1% or less. You go to a $200,000 account, now you're maybe at 0.5% to 0.75%. You go to a $1 million account, and I would say that somewhere in that 0.25% to 0.75% is where you would go, and up from there. So it really comes down to what your risk tolerance is versus the size of your account. So it is, in essence, infinitely scalable. And of course, when you get to these bigger accounts, and even at just 0.5%, you may be putting on 10, 15 positions potentially. It opens up the door for a whole new plethora of position sizing strategies and how you're going to add to positions in a strategic way. So all of that is also taught in this service. So yeah, from a scalability point, from the smallest account to the biggest account. Can I explain what happened today on the SPX? No. Well, I can do a recount of it, but can I tell you what is happening in the SPX every day? I mean, from a volume profile point of view, I think that I nailed it kind of, and I found out where I thought that there was going to be some support. And that was drawn well in advance. As a matter of fact, we drew up all these lines here yesterday when we do our clean slate volumetric, volume profile, market structure redo every week. That's all part of our process. So, can it move down to this next LVN from here down to here? Sure. I think once it gets into this area here, there will be little liquidity and little resistance from it or support from it going down to the next LVN. It could also come back up into this volume node here. But, from my point of view, this analysis that I gave, S1 and S2, was the limits of what I was willing to commit to today. So, and it looks like it hit actually both of those scenarios. The first scenario, it came up. Second scenario, it came down to where I thought it would go. Now, I don't know what's going to happen here for the rest of the day. We're at 1 o'clock. We still have 3 hours left. Can I explain this? I suppose I could go and look at what types of, I don't know.
Returning visitor.
Let's see, was there something in... Well, consumer confidence got hit big time, and that probably had a lot to do with it. But I think most people expected that. The, oh my God, the Richmond Manufacturing Index, and I had mentioned this in the, when I did my market analysis. I said, expect a lower number here. I didn't think it was going to be this low. This is a huge miss. And then, of course, now preliminary wholesales, but look at this, goods trade balance. Even though this is green, this is a monumentally bad number. Anything that is $100 billion in the negative in our trade balance, this is, every day that we get a number like this, it is setting new records in our negative trade balance. This is hugely bad. So everything about this market is bad. I think, so if you're wondering why the market went down, I would say that it's probably mostly due to the consumer confidence index here. I'm sure that pulled things down. I think what's happening here is that in general, let's go back to this. Let's go back here. Hold on. Getting back to the big head. So I think in general what's happening is that the Wall Street and the institutions are now really coming to grips with the fact that the general public recognizes that a recession is coming, and now they're going to all start retracting. Not only is the general public going to retract and maybe hold off on buying decisions and becoming much more frugal with their day-to-day lives, but businesses, this is really kind of a forward-looking thing, that businesses are definitely going to start cutting back. And so the public already is now recognizing this by virtue of that index, and the consumer confidence. But businesses are going to start laying off too. And if you've noticed, it's been just a little bit of an uptick, but the unemployment reports or the unemployment numbers or new cases that are coming on are slowly inching up. I think you're going to start seeing that accelerate. It's going to do, kind of like a hockey stick type of thing. And then once we start getting full-fledged into this recession, the thing about this recession that is particularly bad is that unlike other recessions where inflation may have been, relatively in line, here there is no, I don't know how to say this, but I don't think that there's any real strong expectation that inflation is going to recede like it usually does when we have a recession. A recession usually brings on deflationary pressures. But until this administration and the world gets off of this green kick right now and starts bringing the price of oil down and then consequently the price of food and energy,
Returning visitor.
I believe that this recession is going to continue to go. And they're going to fuel it even more. They're going to fuel it even more because I heard that they're actually considering inflationary stimulus checks.
New visitor.
Could you think of anything more oxymoronic? Inflationary stimulus checks. Every time you pump money out and then monetize that debt, you're increasing the money supply, you're adding to the inflation. That's where we got that's how we got ourselves here in the first place, at least the majority of it. So you want me to explain it? There's my explanation. I think the markets, the institutions, they're coming to the realization that, well, I think they already knew, the realization that the general public now is realizing what is ahead of us. And everybody is going to start contracting. Again, perfect time to join this service and to preserve your capital and stop taking chances and just grow it and keep ahead of the inflation. All right. That's it. That's all I've got to say. I'm going to be doing another video very soon on volume profile and as it applies to TradingView. So hang on for that. And it looks like we're making another dip here, by the way. If we get far enough inside of this area here, we could very easily drop to this next LVN. And I would say that the more that we drop, the greater that the chances are that we will end up down here. So that could start accelerating very soon. So there you go. There's my explanation. Hopefully that helps you. you comply with that. All right. That's all I've got to say. But thank you very much. Peace to you all. See you next video.